So in the dividend method, the first one is called as constant dividends, where this is a formula. KE refers to cost of equity, D divided by P0, where D refers to the constant dividend and P0 refers to the price of the price today, or we call it as 0-year price. So that is about the formula here. So usually all these formulas are expressed in terms of percentages. So multiply 100 even if the formula doesn't have the number. Okay. So we'll start from this question. It says a company has paid a dividend of 30 cents for many years. The company expects to continue paying dividends at this level in the future. So in the past also they have paid 30 cents. In the future also they are going to pay 30 cents. So the dividend is going to be constant. So it's a constant dividend. The company's share price is 1.5. So they're asking you to calculate the KE. So as it is a constant dividends method, we can use this formula. So the formula is KE D divided by P0 into 100. So here the dividend refers to 30 cents. So if it's 30 cents, put it as 0.3 divided by the share price is 1.5 into 100. So the answer comes to 20%. So the KE is 20%. We'll move on to the next sum. Okay, so the next method is called as dividend method. Within that, assuming dividend growth at a fixed rate. So this is the formula D0 into 1 plus G divided by P0, the whole of this plus G. Okay, so first solve all these within the bracket, then solve the G part. What does this refer to? See, D0 refers to the any zero number which is given refers to the starting year. Okay, and any D1 refers to the next year. Okay, the starting of the next year. So they say that D0, that is the dividend today, okay, into 1 plus G, that is the dividend is going to grow. The G here refers to the growth rate in dividend, the constant growth rate in dividends expressed as a decimal. So G refers to the growth of dividend. So if you are going to do this, you will be like getting D1. Okay, so this part of the equation is D1. The 0 plus the growth equals to the next year dividend. Okay, you can even put it like this. If there's D1 plus 1 plus G, then what you will get is you will get D2. Okay, you can keep on going like that. D2 plus 1 plus G will give you D3. Okay, but we are not like bothered about that. This is just for explanation. To do this sum, we just need to get the apply the numbers here. So we'll start. So we'll have KE. So KE equals to D0. What is D0 in this problem? We'll read. Pico has just paid a dividend of 10 cents. So it's 0.1. To 10 cents is 0.1. Shareholders expect dividends to grow at 7%. So 7% is 1 plus 7%. Pico's current share price is 2.05. So 2.05 is the P. The formula says D0 plus 1 D0 into 1 plus G divided by P0. So that's what we did. And finally, we have to add the G. So again, the G will be added as 7%. So we'll work it now. 0.1 into 1.07. So 7% has been added divided by 2.05 plus the 7% can also be 0.07. So we'll solve the internal part of this. Internal part comes at 0.052. So we'll add the 0.07. It gives us 0.122. As we said, all these formulas should be expressed in percentage. So this can also be expressed as a percentage, like into 100 you put. So 12.2 is the cost of capital. Okay. So whatever answer you get, multiply it by 100, then only we will get the percentage. The company has recently paid a dividend of 0.23 per share. The current price is 3.45, and if dividends are expected to grow at an annual rate of 3%, what is the key? So it's just as similar as the previous problem we did. So 0.23 is the dividend per share. The growth rate of dividend is 3% divided by 3.45, that's a share price. The whole of this is added with the 3%. So we have 0.23 into 1.03 divided by 3.45. All this has to be added with the 3%. So 3%. So we can solve now. Comes to 0.0686 plus we'll add the 0.03. So put together the answer comes to 0.0986. So either it can be expressed like this, or you can multiply this with 100. Okay, you can multiply this with 100. The answer then comes to 9.86 percentage. Okay, so the K is 9.86. We'll move on to the next problem. So here we have a next concept. It's called as the X dividend share price. So it says the current share price is 140 cents and a dividend of 8 cents is due to be paid shortly. Required, calculate the P0, the X dividend share price. So what is this X dividend share price? So in the formula when we did it, for example, KE equals to D0 divided by P0, okay, or the other formula that we did, which is D0 1 plus G divided by P0 plus G, either this formula, the P0 here and here, okay, they refers to a price. What price? That is the X dividend share price. Okay, so why should we take this X dividend share price? Because if you take a share price movement, what happens is it might be trading at a price of 10 rupees for a long time, and suddenly the company might declare a dividend of 3 rupee. So once it has declared here, the share price will immediately fall to 7 rupee and again it will trade. Now this part, okay, before this it's called as cum dividend price, and after the declaration of dividend it's called as X dividend price. Okay, while computing the problem, should you take the cum dividend price or the X dividend price? You should take the X dividend price. You have to find out the X dividend price and then use that as the P0 in the formula. So we'll work out this problem. So in this problem, he's asking you the X dividend price. So the X dividend price is, the formula works like this. Get the cum dividend price minus the dividend So the cum dividend price is 140 cents. Dividend is 8 cents. So the X dividend price is 132 cents. Okay. So this is usually a part of a lengthier problem. So again, we have another problem here, the X dividend price. D is about to pay a dividend of 15 cents. Shareholders expect dividends to grow at 6% per annum. Dco's current share price is 1.25. Calculate the cost of equity, he's asking. Okay, so look at this problem here. He says Dco is about to pay a dividend of 15 cents. Okay, so the company is going to pay 15 cents. It means this price is the cum price. Okay, so we have to find out the X price. First we will find out the X dividend price. So X dividend price equals to the cum price, which is 1.25 minus the 15 cents. So the answer would be 1.1. Okay, so we'll now do the formula. So the KE formula we'll do. Formula is D into 1 plus G divided by P0, the whole of this plus G. So the D0 is 15 cents plus 1 plus G. 1 plus G is 1 plus 6% divided by the P0. P0 is 1.1. So take this number plus again the G. So this comes to 0.144 plus 0.06. So the answer comes to 0.204, or if it's expressed in percentage, 0.204 into 100, which is 20.4%. So that's the answer. KE is 20.4. We'll move on to the next problem. So here he's saying sometimes we have to find out the growth rate in dividend. So he will not give you the G in the equation. So there are two ways to find out the G. So one is called as a past dividend method. So in past dividend method, if the growth rate can be again found in two ways in the past dividend method. For example, if only like 2 years numbers are given, okay, two dividend numbers are given. For example, the current year dividend and the last year figure. Then this is the formula: current year number divided by the last year's number, okay, minus 1 into 100. Mostly they won't tell you to find out this method, okay. What they will ask you is to find out through this second method, the compound annual growth rate method, or the CAGR method, where the formula works like this: nth root divided by current figure, okay. So the current year number, what is the current dividend, and the oldest dividend, okay. Once you get an answer for this, once the answer you get, you have to minus it by 1. That answer you have to multiply by 100. You will get the growth rate G, okay. So that's how the formula works. Here the word N refers to the number of years of the dividend. So we'll work out this problem. The company currently pays a dividend of 32 cents. 5 years ago, the dividend was 20 cents. Estimate the annual growth rate in dividend. So we'll start with the dividend growth rate. So the number that you'll get is a percentage number. So we'll start. Nth root. So number of years is 5. Okay, so we have to get the fifth root. The latest dividend is 32 cents. And the oldest dividend is 20 cents. This answer minus 1 and then multiply it by 100, you will get the percentage. So first we will solve this part of the equation. So we'll start. 0.32 divided by 0.2 is 1.6. So we have to get the answer for 1.6. So 1.6 comes to, this answer comes to 1.098. So from this you have to deduct 1 and multiply 100. We'll do it here. Deduct 1, the answer comes to 0.098. Then we have to multiply it by 100. We will get 9.8%. So the growth rate in dividend is 9.8%. So how do you take this fifth root? See, you can't do this in a normal calculator. You can't do this in a normal calculator. You need a scientific calculator. You need this. So what is the step? So this is the step. First, press the number 5 in your scientific calculator. The second is press shift. Okay. The third is to press, there's a symbol like this. Okay. Press this symbol so that you will get this. This would equal you to this number. If you see your calculator, you will have this symbol. Okay. But when you press shift and you press power button, you will get the xth root. So you have already pressed the fifth 5 and now it will give you the fifth root. So after this, your fourth work is to press the 1.6 and finally press the equal. You will get the answer in your scientific calculator. Okay. So these are the steps. Look for this symbol. Okay. That's like very important. And above the symbol, you have this also printed in your calculator. Okay. So these are steps to find out the nth root. So without scientific calculator, you can't work out this sum. So even in exam, you have to take the scientific calculator with you. So now we'll move on to the another problem. So it is the same as the earlier problem. The company has paid the following dividend over a period of 5 years. Okay. So how again this works? So our job is we have to find out the growth rate in dividend. Our formula is N. So latest divided by oldest minus 1 and into 100. That's our job. So the crucial part is N. In the question, if they are going to give you just years, then you can take 5 years. But if they are going to give you the first year number 2000 and the last year's and the latest year's year number as 2004, then in that terms you can't take just like what he has given like 5 years. You have to count it. So how many years are here? It's not like 5 years, because in cumulatively if you take 2000 to 2001 is a first year, 1 to 2 is a second year, 2 to 3 is a third year, 3 to 4 is a fourth year. So there is actually not 5 years, there are only 4 years. Okay, so if he mentions you the year number, then you have to work out like this only. That is the only difference. Apart from that difference, the formula is same. The latest dividend is 14.5, the oldest dividend is 10 minus 1 into 100. So we'll work out the problem. So we have to get the fourth root of 1.45, 1.077. So again minus 1 into 100. So that comes to 0.077 into 100. So that comes to 7.7%. So that is the growth rate in dividend. So we'll move on to the next problem. So there is a second model in which we have to find out the growth rate in dividend. So that is called as the earnings retention model or Gordon's growth model. The formula is like very simple. The growth rate in dividend is B into R. So what is R? R refers to the rate of return on investment or ARR. So you have to take the ROI or ARR, and B refers to the earnings retention rate. So what is retention rate? Retention rate is if a company earns profit, it can do two things with that. One, it can declare it as dividend or have it as reserve. Okay, it can do two things with its profit. So retention rate is how much of profit is retained. So we can put it like this. So it can we can refer the B like this. B equals to earnings minus dividend divided by earnings. So earnings minus dividend is what is being like retained. Okay, so this is the reserve part. So into 100. So if you do this, you will get the B. So we'll try to do it. A company has a profit after tax of 1 lakh and declares a dividend of 40,000 every year. It has an average ROI of 25%. What is the dividend growth rate? So we'll start from the B. Okay, earnings retention ratio. See, the earnings is 1 lakh. The company has made a profit of 1 lakh. 40,000 has been declared as dividend. That means 60,000 is retained by the company. So 60,000 has been retained by the company. It means that they are retaining 60%. So their B is 60%. So we will solve it again. We will try to get the G dividend growth rate in dividend. So the formula is B into R. B into R. B just now we found out it is 60% into what is R? R is directly given as 25%. So we will try to find out this number 0.15. So as this has to be in a percentage, we will multiply it by 100. So we'll get an answer of 15%. So the growth rate in dividend is 15%. Okay. So again, this is a 2-mark problem, or this might come as a part of a 10-mark problem. So we have the estimating the cost of equity. So this next model is called as the CAPM model. So this is a very important model because it's It comes in several chapters. So CAPM has a formula like this. Okay, expected R or investments equals to RF plus beta plus ERM minus RF. So we'll simplify this formula and write it here. So the cost of equity can be said as RF plus beta into RM minus RF. So that is the formula. So here the RF refers to risk-free rate of return, or something they call as treasury bill rate. Treasury bill rate. Okay, so that is risk-free rate of return. B refers to beta. So he will tell you beta is systematic risk. So B refers to beta. Either the word beta or systematic risk will be given. RM refers to expected market return. So this is RM, expected average market return. So that is ERM. And this is like very important. In some questions, they will tell you risk premium, equity risk premium. If they give you equity risk premium, that means it is RM minus RF. That is, they have done this part. Okay, they have subtracted this RM minus RF and they have given you the answer for it. Your job is to just substitute this number here. You don't need to again deduct it. So RM, if they give you equity risk premium, RM minus RF has already been done. Okay, so we'll try to solve this problem. The current average market return being paid on risky investment is 12%. Okay, so the average market return is 12%. So what is that? That is the RM compared with 5% on treasury bill. So 5% on treasury bill is RF. The beta is 1.2. It's directly given. What is the required rate of return for a equity investor? So our job is KE equals to RF plus beta into RM minus RF. RF is 5. So if you're going to take it as 5%, then the answer will be in percent. If you take it as a whole number, it means it is already referred in the percent itself. Okay, so we'll take it as 5 itself. So beta is 1.2. It's 12 minus 5. So the answer comes to 1.2 into 7. We'll solve it here. 5 plus 8.4. So that comes to 13.4. Okay. See, this 13.4 itself is a percentage because all the numbers here are percentage. 5 is a percentage, 12 is a percentage. So the entire number that you get at the last is also a percentage. So you don't need to multiply it by 100 because it's already in percentages. Or else you can also work it like this. For example, if you want, you can work out this part like this. You can work out that as 0.05 plus, plus 1.2 into 0.12 minus 0.05. If you do like this, your answer would be coming up as 0.134. Then you have to multiply it by 100 and finally you will get 13.4%. But compared to this method, this method is always better because it's quick and easy. So try to do through this way. We'll move on to the next problem. So again we have the CAPM problem. So BCO is currently paying 9% on equity investment. So their KE is already given 9% on equity investment. If the return on gilts, okay, gilt or treasury bill, gilt is also referred as treasury bill, is 5.5. So this is the RF and the average return on the market is 10%. So the return from the market is RM. What is the beta of BCO and what does this tell about the volatility of B's return compared to that of a market on average? So we'll try to do this. Here we'll just do the sum. We'll have the formula. So KE he has given, that's 9. RF is 5.5. Beta is what we have to find in this problem. Rm is 10.5 and Rf is 5.5. So we'll solve it. So first we will take this 5 this side, okay, because this has to be solved separately. So we'll take the 5.5 that side. So 9 minus 5.5 equals to beta into 5, 3.5. So 3.5 equals to beta into 5. So we'll take the 5 that side. So 3.5 divided by 5, that is the answer comes to 0.7. Okay. So as discussed in the theory, okay, this company has 0.7 beta. So the normal index beta is always 1. This is like always. This company, okay, Bco's beta is 0.7. It means it is less, that is Bco is less volatile. So that's what he asked in the question. What is the beta of Bco and what does this tell us about the volatility of B's return compared to those of the market? So average is 1. Anything which is below than that, it is less beta and it means it is less volatile. So Bco company is less volatile. So that is the answer. So now we'll move on to cost of preference shares. So this is the formula. Kp equals to D divided by P0, where D refers to the constant annual preference dividend. So usually preference dividends, they don't grow, they are just a fixed number. And P0 refers to the X dividend market price of the preference share. So we'll start with the Kp. So Kp equals to D divided by P0 into 100. So we have to get D and P0. A company has 50,000 8% preference shares in issue. Nominal value is 1. The current X dividend market value is 1.2 per share. What is the cost of preference share? Okay, so you don't need to take this whole number like 50,000 and all. You just need to take a per share value. If you get a per share value, it's easier to solve the problem. Okay, it's very easy to solve the problem. For example, what is the dividend per preference share? See, dividends are declared at the face value or nominal value. So 1 is the nominal value into what is the percentage of preference dividend given? It's 8% of the nominal value. So it's 8% divided by the current X market value of the preference share, that is 1.2. So we can quickly solve it. The answer would be, the numerator is 0.08 divided by 1.2 into 100. So the formula is always into 100, which gives us 0.0667. So if you take it as 100, that would be in percentage, that is 6.67 percentage. Okay, so this is the easiest way to do it. Normally they will give you the nominal value. Okay, based upon a nominal value, compute the dividend per preference share, find out the price per preference share and solve it. You can also solve it with the whole number basis, but whole number basis will take a long time for you to solve. Okay, so if you want, we will solve through that also. So if you are going to solve it through the whole numbers, okay, $1 is the nominal value, 8% is the dividend percentage, 50,000 is the number of dividends that are being in issue. So that is the total worth of dividends. If you multiply, that's your numerator. Your denominator is the total value of preference shares. So total value of preference shares come to 50,000, 1.2 into 50,000. If you solve this, usually again this and this gets cancelled. So either way, it's better to always do the problem in per share value itself. That's about the cost of preference shares. So we'll move on to the cost of debt. So irredeemable debt, we'll start with this one. The formula works like this. The question might tell you whether to compute KD. KD is refers to cost of debt. KD before tax or KD after tax. If it's KD before tax, the formula is I. I is the annual interest rate in the bond or debenture divided by MV. MV is the market price of the loan or debenture. If it's going to be after tax, it's I into 1 minus T divided by MV. So T is the tax rate. So why do we deduct 1 minus T? Because this gives you this 1 minus T. 1 minus T gives you the after tax cost. Okay, so the tax benefit has been like deducted here, and then we find out the interest. The question will state whether it wants before tax or after tax KD. So we'll work out this problem. A company has an issue 10% irredeemable debt quoted at 80x interest. The corporation tax rate is 30%. What is the pre-tax cost of debt? So as he asks you the pre-tax, so pre-tax is before tax. Okay, so simply he wants us I divided by MV. Always the formula is into 100 only. So what is the I? I here refers to 10%. Interest is 10% divided by 80 is the market rate, and finally we have to multiply by 100. Now the question is I refers to the interest, okay, but on what? On the nominal value. Okay, I is always on the nominal value, but nominal value is not at all given here. The nominal value is not given in the problem. Then how do we work it out? See, nominal value and market value are related. Okay, so in this question market value is 80, that means nominal value should be 100. If the market value is 0.8, then the nominal value will be 1. If the market value is 800, then the nominal value will be 1000. Okay, so usually the question will tell you this nominal value we have to find out, because the price would be like trading equivalent to the nominal value, and nominal values will always be 100 or 1 or like 1000. So the price can also be like this. The price can also be $120 or $1.2 or $1,200. So if the price is going to be in some kind of a range like this, usually the nominal value is like this. So in this problem, as the market value is 80, the nominal value should be 100. So the numerator will be like 10 divided by 80 into 100. So that gives us 0.125 into 100. So that gives us 12.5 percentage. Okay, so the KD before tax is 12.5 percentage. In post tax, we take the tax benefit into account. So formula works like this: what I into 1 minus T, entire thing into 100. So in this formula 1 minus T refers to T is 30%. So we'll take it as 0.3. So now we'll solve. So the numerator now will become to 7 divided by 80 into 100. So the answer will be 0.0875 into 100. So when we multiply, we get 8.75. So that's about the post tax. So we'll just have another discussion. So we had KD pre-tax return. I think the answer was 12.5%. So the pre-tax will always be high, okay, when compared to the post-tax, because there is a tax benefit here. So that's why we got the number. So that's about the problem here. We'll move on to the next one. So we look at the redeemable debt, or debt which is issued and can be like bought by the company after a set of years. To find out the KD for this kind of a problem, we have to find out the IRR. So this is a format. So first take 3 rows. The first row refers to the market value. The second row refers to the interest payment. If the question asks you post tax, then it is like 1 minus t. If it asks for pre-tax, then you don't have this number, 1 minus t is not there. Okay, usually question will ask you post tax only, so 1 minus t will be there, and the last number is capital repayment. So we have to do these things. Okay, annuity factor, discount factor, and these amounts. So we'll just look at how it works. A company has in issue 12% redeemable debt with 5 years to redemption. Redemption is at par. The current market value is 107.59. The corporation tax is 30%. What is the required rate by debt providers? And he is asking you pre-tax, but what we'll do is we'll try to find out the post-tax, because that is what is asked in exam. So we'll find out what is post-tax KD. See, we'll set this as a question. So we'll start now. So our job is to find out the IRR. So how do we find out IRR? So now it works like this. So we'll start with the table. We have the year. We'll have the cash flow. We'll have the discount factor at. That is what we have to find out. So we'll take it as discount factor at. Usually the discount factor, whatever number is given here, take the same number, okay, and compute it. You will get a present value. Again we have to do another discount factor at. That number we'll do later, and we have to get the present value. So this is the table. We'll insert the numbers in this table. The first is the market value. Market value, you are buying the bond now. Now it's called a 0th year. So the cash flow is you're buying the bond, so it's 107.59. Mark it with the minus symbol here. Okay, so because you buy the bond, so the cash goes out. The discount factor for the first year is always 1. So we'll move on to the next one. It's called as interest. So interest is being paid for how many years? From the first year to the 5th year it is being paid. Okay, 1 to 5. It's not minus, it's 1 to 5 years. And the cash flow is per year how much of cash flow we get. So interest is 12%. Okay, but if you take after tax interest, let's see how much it comes. So 12 into 100 into 12 percentage into 100 into 1 minus 0.3. So this gives you the after tax interest. This is interest. How did we get 100? See, then market value of bond is 107. It means that then the nominal value is 100, gives you 8.4. And last one is redeemable value. So redemption is, he says it is at par. Okay, at par means what was the nominal value? So at par means nominal value we have to get. What is the nominal value? If the share is trading at 107, the nominal value should be 100. In which year you are going to get this cash flow? You are going to get it on the 5th year. So you are buying the bond today, so it is 0. You are going to get interest for 5 years from the first year end, second year end, third year end, fourth year end, and 5th year end. Redemption you are going to do at the 5th year end, and these are the cash flows. Okay, so we have to get certain numbers. So first we'll try to get this number, annuity factor. The annuity factor you have to get for 5 years at 12%. So the annuity factor we have to get it for 12% for 5 years. So 5 years comes here. So 12% 5 years comes to 3.6. So it comes to 3.6. And the redeemable value for 5 years, okay, and cash flow is 100. See, this interest is received for 5 years, that's why we took annuity factor. This redemption value comes only on the 5th year only. So for that we have to look at the discount factor table. So again we look at the discount factor of 12% for the 5th year alone. We have another table. So the table is at 12% for 5 years. The discount factor is 0.567. It's 0.567. So you'll find out the PV. So the PV comes to multiply 8.4 into 3.6. Okay, multiply the cash flow and discount factor, you will get the PV. So the PV comes to minus 107.59. The interest comes to 8.4 into 3.6 comes to 30.24, and the last number comes to 56.7. 100 into 5.56 is 56.7. So we'll add all these numbers and let's get the answer. So the answer comes to minus 20.65. Okay, so now what we have to do is, as we get a negative I number here, we have to take a lower discount factor. So we'll take a lower discount factor, something like 6, and we'll do it the same procedure. So now we are going to multiply this cash flow with this discount factor, and we are going to get this answer. Okay, so we'll do the same procedure. The first year number is always 1, so that is not a problem. We have to get annuity factor of 6% for 5 years. We have to get for 5 years 6% annuity factor, so it comes to 4.212. Comes to 4.212. We look at the discount factor again at 6% for 5 years. 6% for 5 years, it comes to 0.747. Comes to 0.747. So we'll multiply the numbers. So the first number is 107.59. So the second number is 8.4 into 4.212. So the answer comes to 35.4, and the last number comes to 74.7. We'll add all of them. So the answer comes to plus 2.5. Okay, so now we have to find out the IRR for this. So what is the formula for IRR? Low discount factor plus NPV at low discount factor divided by NPV at low discount factor minus NPV at high discount factor. Solve this and multiply this by high discount factor minus low discount factor. Okay, so we'll insert the formula. We know that the low discount factor was 6. Okay, and we look at the other numbers. The NPV at low discount factor is 2.5 and the high discount factor is 20.65. So NPV at low discount factor was 2.5. The formula has a minus, and the NPV at high discount factor, this number NPV at high discount factor 12%, that comes to minus 20.65. Minus 20.65. Okay, solve this part and then multiply it by the high discount factor, which is 12. Low discount factor is 6. So we'll start 6 plus, we have to solve the inside part. So it's 2.5 divided by 2.5 minus, and another minus becomes a plus, so that comes 20.65. So the denominator is 23.15. This minus and minus becomes a plus. Okay, so solve this and into 6. 12 minus 6 again becomes a 6. So we'll solve 6. The answer comes to 0.64. So the total answer comes to 6.64. Okay, so this is the KD of redeemable debt after tax. It comes to 6.64. Okay. So the next one is non-tradable debt. So what is a non-tradable debt? A bank loan is a non-tradable debt, so you can't trade it with anyone. So we have to find a KD for this kind of loan also. So mostly we can find out the post-tax or after-tax number. So we can directly get it. For example, you just get the interest rate. So for this we can just multiply the interest into I minus 1 minus t. So the interest here is 11% into 1 minus t. T is the tax rate, so 30. So we can directly get the answer. So it would be like 7.7%. Okay, so it's like very simple and direct to compute. So the next one is the, and the last one is the convertible debt. So the convertible debt is like very similar to the redeemable debt. but the only part is it has a converting option. That is, in the last year, the redeemable value can either be a bond value or it can be share value. So whichever is higher, is the formula. So whichever is higher, choose that number. So that's how it works. So these are the calculation parts. To calculate the cost of convertible debt, there is no tax effect whichever option is chosen. Okay. So there's no tax element in the bond value or share value. Calculate the value of the conversion option using the available data. So first find out this one, he says. Compare the conversion option with the cash option. Assume all investors will choose the option with the higher value. So that is why we say that whichever is higher, uh, calculate the IRR of the cash flows as redeemable debt. Okay. So this is the only part where the redemption value is either a bond value or the share value, whichever is higher, you have to choose. So we have a problem here. A company has issued convertible loan notes which are due to be redeemed at a 5% premium in 5 years time. The coupon rate is 8% and current market value is 85%. That means the nominal value should be 100. And alternatively, okay, the investor can choose to convert each loan note at 20 shares in 5 years time. The company's tax rate is 30%. The company's shares are currently worth $4 and their value is expected to grow at 7%. Okay. So first what we'll do, we'll find out the convertible option value of converted shares in 5 years. So we'll first look at the value of converted shares in 5 years time. So what would be its value? See, the share value will be, currently the shares are worth $4 and they will grow at a rate of 1.07 for how many years? For 5 years. So first we'll get this number. So first we have to get 1.07. So this comes to $4 into 1.402. So the value will be, the share value in 5 years will be 5.61. Okay, but this is for per share. We have to get the value of 20 shares, because that's how one debenture of $100 will be like converted into 20 shares. Okay, so and 20 shares value we should know. 20 shares into 5.61 equals to 112. Okay, so the share value is 112. So now the question is this: which will be the redemption value? Redemption value will either be the nominal value of debenture, which is $100, or it would be the shares. The shareholder will redeem it at 112. So which one he will choose? Whichever is higher, that means he will choose 112. So that's about the convertible option. So he has the option to convert the bond into shares and he will get 112 as a redemption value. From here on, it is a normal redemption problem. Okay, it's a normal redeemable debt problem. So we'll try to solve that. We'll start with years, then cash flow, then discount factor at, then we get the present value. Again we do the discount factor at, we then again get the present value. So first we have to get the market value, then the interest, then the redemption value. So this is the 0th year, this is the 1 to 5 years, and this is the 5th year. Market value is 85 and redemption value is 112. The bonds are converted at a premium of 5%. So that means the bond will be like converted at 105. So whichever is higher, whether 105 or 112 is higher, 112 is higher. So the bond will be redeemed at 112. Take it 8 and let's see how this works. So first year number is always 1. So the present value will also be 0.85. Whatever discount factor you choose, it is always going to be the same 1. So we have to look at the annuity factor table here and discount factor table here. 8% and 5 years comes to 3.99 to 3.99 and 8% and 5 years comes to 0.681. So we'll compute the answer. Okay, so this comes to 13.6, which is a positive number. So we'll look at the discount factor of 12%. As 8 has come to 13.6, we'll take a higher discount factor so that this number would go to a negative. NP will go to negative. So the answer comes to 0.836. Okay, so if you see the answer is like very close, I think the IRR will be like nearby to 12, but we'll work out the IRR. So IRR will be the low end discount factor 8% plus the NPV at the lower discount factor, which is 13.6, divided by NPV at lower discount factor 13.6 minus, then we have a minus of 0.836. Okay, this into the difference between the high discount factor minus the low discount factor. So we'll try to solve the number here. So that comes to 13.6 plus 0.836. So it's 13.6 divided by 14.4 into 4. So the answer comes to 8 plus 3.78, which refers to a total of 11.78%. So this is the KD. Okay, this is the cost of convertible debt.